Hello and welcome everyone to another edition of Startups Ask. We are a show which brings out exciting news, exciting happenings in the world of startups, in the world of venture capital funding, and across the world, we focus on uh, how investors think, how startups work, and anything which is exciting and happening. So this week, I have brought to you another edition of Startups Ask. My name is Tushar Kansal. Let me share my screen with you. Uh, yeah, this is Startups Ask. So this week, uh, we are focusing on the deals which happened, and this is about me. I am a founder of Consultancy Ventures. It is My background has been in Big Four consulting like Deloitte and Touche, venture capital like I was handling assignments in brand capital, and London Stock Exchange listed Systema's India unit MTS India, and I was CFO of a Guggenheim Partners owned company, Distribution Logistics. I'm a mentor and judge at top colleges across the world. I have done my executive education from Harvard Business School. I'm also a venture advisor with Loyal VC, the INSEAD led Canadian VC fund, and a partner with GSD Venture Studios. It is my pleasure to take you to some very interesting deals this week. Uh, about my company, Consultancy Ventures, we are into funding, we are into pitch deck preparations, presentations, valuation. We are into raising money for your company and also raising money for venture capital funds. And we also provide mentoring assistance to startups and companies. So let us look at the deals of the week. Um, for the first time, for the first time in India, a 6-year-old online pharmacy startup called PharmEasy acquired a 25-year-old publicly listed company called Thyrocare, and they did that to expand into offline healthcare diagnostic space. They bought 613 million worth of stake, 66.1% stake in Thyrocare. Now, this deal is very interesting. We have seen in the recent past how fintech companies are buying out banks. Companies which were just set up 2 years ago, 3 years ago. And here we have a online pharmacy company buying out a 25-year-old brick and mortar company called Thyrocare. Another interesting phenomena, the company Shuttle, which provides buses and big vehicles for office commute across the best cities. It faced cash problem, and it has announced that it has laid most of its employees and they can't ride the pandemic, and they're looking for buyers to sell whatever is left of their operations. Then PolicyBazaar.com, the first and the largest online insurance company. It's an insurtech company. They are planning to raise $500 million at a valuation of $5 billion, and they have also moved into offline insurance space by opening 15 stores. Then another news, very interesting, Lenskart, which is a which is eyewear unicorn, more than $1 billion valuation. It has plans to open 300 more stores, and it has set up a vision fund to invest $20 million in startups. Then more exciting news, insurtech startup Acco is raising $200 million fresh capital. Online grocery delivery startup Grofers has raised $120 million from Zomato the food tech company, and Tiger Global. And EdTech startup Class Plus has raised $65 million from Tiger Global. Some very intriguing phenomena. ByteDance, which runs TikTok, is selling TikTok's artificial intelligence. It's selling the algorithm across Asian markets. Uh, they were banned. TikTok was banned in India along with a lot of other Chinese apps because of the border issue with China. And now they plan to sell their AI algorithm, which is quite a unique phenomena because their AI was actually responsible for getting them 600 million subscribers in India alone. Then we have Furlenco, which is a furniture rental startup. It raised $140 million, led by Zinnia Global. The dating app Bumble, it opened a brick and mortar branded cafe and wine bar. So moving from online to offline. And Licious, which is the direct to consumer D2C meat company, it raised $192 million in Series F funding, led by Temasek and multiples private equity. Now, amongst all this, I want to specifically focus on one deal, and it is a deal, a startup called 10 Club, which raised $40 million seed capital, led by Fireside Ventures and Heyday, PDS International, Class 5 Global, Sikosha Ventures, and founders of the hardware startup Boat. Now, 10 Club is actually a company which acquires small brands that sell their products on e-commerce platforms, and after acquiring those brands it scales those businesses. It is replicating what is popularly known as Thrasio model in India. Thrasio is a US based company which is valued at which has raised more than $1.3 billion in equity and debt, and it has consolidated about 6,000 third party sellers on Amazon as of earlier this year. Now, 10 Club is competing with companies like Mensa Brands, a similar venture by former fashion e-commerce Myntra chief executive, and Mensa raised $50 million in equity and debt. And Upscale, another prominent player in the space, is in advanced talks with Germany's Razer Group to raise capital. Now, uh, what is the business model behind Thrasio, behind 10 Club, and behind Mensa Brands? They acquire brands that sell mid range to high end products in categories where competition is limited. In fact, some of the categories that are common amongst those brands are so underappreciated that even Amazon and other e commerce firms have not explored them through their private label ecosystems. The interesting theme behind 10 Club's business and the work they did before raising $40 million, I would request a lot of startup founders to listen to this very keenly. They had signed letters of intent worth $15 million from several firms before they raise the capital, and they will deploy the fresh capital to operate the new businesses. And they had validation of business worth $15 million. Mensa Brands, which is the new venture of former Myntra CEO and MedLife co-founder Ananth Narayanan, raised 50 million in a mix of equity and debt last month. Now, other similar companies are Goat Brand Labs, started by Flipkart alum Rishi Vasudev. It's about to raise 20 million from Tiger Global. First Cry, which is expected to launch Thrasio style investment venture called Global Bees. And they have a $75 million capital commitment already. Now, another interesting aspect of 10 Club deal is that these big bets, like $40 million bet and $50 million bet, they seem to be largely on 2x entrepreneurs who have already done a successful business before or a successful exit before. Many of these founders started 10 years back, they exited, and now they are starting out again. And you know, the negative side which people, some investors say about this deal, that the mega funds, are they killing the seed fund business model? Because capital is itself a moat when you fund it so well initially and so early in the game. Then the bootstrap model will be in danger. And are we pushing the envelope too much, a bit too much? That is what a lot of investors are asking. And the one of the founders of 10 Club is a woman, and there is a report by State of uh, a report called State of Women in Tech Entrepreneurship. It says that there has been an 11 times increase in the number of women entrepreneurs in the last decade. And still, the total number of women founded and co founded tech startups in the country, in India, is only 285. And Miss Suresh, who has built brands, who is one of the founders of 10 Club, she has built brands like La Moody Philippines and Women Wear on Demand rental service Style Bank. And she completed her MBA from HEC Paris. La Moody Philippines, in fact, it was a real estate startup which allows you to buy, sell, and rent property in Philippines. The company raised $56 million from Asia Pacific Internet Group and Axel Springers, and it was acquired by Digital Classifieds Group's Emerging Markets Property Group last year. So she is a 2x founder, uh, and she had already proven. And now, along with two of her other co founders, she raised $40 million for 10 Club, which is a Thrasio styled business. Now, this interesting deal caught my eyes because of the size of the fundraise at seed stage and also the tremendous potential in this space to scale up, acquire and scale up brands. Similarly, another incident which caught my eye during this week was the Chinese company Didi Chuxing and its troubles with the Chinese government. The Chinese cybersecurity watchdog CAC, they had urged the ride-hailing company Didi Chuxing to delay its $4.4 billion New York IPO, and they said they had security concerns. Didi was banned from app stores on Sunday by the CAC of China, and now it faces a probe over unspecified national security issues. Now, this is big. Didi Chuxing is the biggest ride hailing company in China. Uber tried to compete with them, they failed, and they sold out their Chinese venture to Didi Chuxing. It carries out 600 million rides every day in China, and it is present in 15 other countries. And its valuation it was seeking for the New York Exchange IPO was $100 billion, but in the end, it got a valuation of $67 billion. Now you can imagine a company with this kind of business and its app, which is the source from which it gets its business, gets banned. It gets taken off from the stores, the app stores. It is a big move by the Chinese government. They had urged Didi Chuxing to pull themselves off from the IPO, the NYSE IPO, and but Didi Chuxing went ahead with the last week's listing. Now, what is happening is that China's scrutiny of Didi is the latest move in a wider crackdown on major US listed Chinese tech firms. They announced after this move, the Chinese government, that they will review truck hailing platform Full Truck Alliance and also the owner of popular online recruitment site Boss Ziffin. And all three platforms were told by the CAC to stop registering new owners so that, in quotes, to prevent security risks to national data, safeguard national security, and protect public interest. So, in a way, the Chinese government was worried that the tremendous amount of data on Chinese citizens, which is generated and captured by the Chinese tech firms like Meituan, like Didi Chuxing, like Tencent, like Alibaba, like WeChat, if they list in international stock exchanges, then there might be a chance that this data falls in the hands of other governments, specifically the European and US government. And uh, it is actually such a move from the Chinese watchdog. It is a sign of Beijing's discomfort with overseas listings. And it is a fresh regulatory offensive on Chinese tech firms whose shares have suffered in the recent months after uh, Beijing's market regulators enhanced their antitrust campaign. In April, Chinese authorities handed a record fine to Alibaba and warned 34 other companies to rectify their behavior. Didi Chuxing was founded in Beijing 9 years ago. It began as a taxi hailing service before expanding into other forms of transportation. In 2015, it had merged with another Chinese rival, Kuadi Dache, to form what became Didi Chuxing. Didi has since been dominant in China. In 2016, Uber, which has been spending heavily to grow in China, sold its Chinese operations to Didi. Didi operates in 15 countries, including Brazil and Mexico, serving over 493 million annual active users and powering 41 million average daily transactions. This is the figure till March 31st, 2021. And the trend of Didi raising such a huge amount of money at a very rich valuation, it has caught on. So earlier this year, Singapore's biggest ride-hailing firm, Grab, it struck a $40 billion deal with the SPAC, Special Purpose Acquisition Company, to go public in the US. Uh, so, very interesting happening with the Didi Chuxing. Earlier, we had seen how Jack Ma of Alibaba faced trouble with the Chinese government after his outspoken comments on the Chinese banking and financial regulators was disliked by the Chinese government. And the Chinese government is calling out the other tech companies, citing alleged offenses uh, and the monopolistic practices of these companies, including inconsistent pricing, user privacy concerns, and difficult working conditions. So the water is yet to flow under the bridge on this issue of Chinese government reining in huge and big Chinese tech companies. And just as antitrust behavior of the US regulators was there when AT&T was broken up, and the same has been, the US government is saying that Facebook, Google, Microsoft, they are become too big, and there is a monopolistic tendency in the business of these companies. Similarly, the Chinese government also is after their tech giants, and so that is something which which we will see increasingly more as time passes by. Now, another interesting thing which happened this week. Let me show you the pictures of a brand new factory which is being set up in the Indian state of Tamil Nadu. It is world's largest uh, two-wheeler factory being made by Ola, and this is the picture of the scooter which they are creating. Very interesting, world's largest, and hence very interesting. And so the good part, let me tell you the wonderful part about this factory and why this matters a lot. This factory is being created on 500 acres of land. It will cost around $3 billion. Uh, Sorry, it will cost around $300 million. It is the world's largest two-wheeler factory. It will produce 2 million units of scooters every month and 25,000 batteries per day. It will create 10,000 jobs. The price per scooter would be 100,000 rupees, which is around $1,500 per scooter. And it will also create a hypercharger network which will include 100,000 charging points across 400 cities in the country. And for ensuring that the design of the scooter is good, this company, Ola Electric, they had also acquired Amsterdam-based Itago BV last year. It was aimed at bolstering its engineering and design capabilities in the electric mobility space. This plant will have 10 general assembly lines and will be able to roll out a scooter every 2 seconds. And these scooters will be exported to Europe, UK, Latin America, Asia Pacific, Australia, and New Zealand. And this massive scale promises competitive pricing, and they will compete with the scooters from other companies like Bajaj Chetak, Ather 450X, TVS iQube, and in fact, Ather Energy, which is one of the leaders in electric vehicles and scooters in India. They are ramping up their capacity by more than 3 times, and that is also because of the government's Indian government's PLI scheme, production linked incentive scheme, where they get a 6% payback from the government on their revenue. So, uh, so today we covered some news about the happenings this week in the startup world. Then we covered 10 Club Deal, which is a company which raised $40 million seed capital. And then we saw a bit about Didi Chuxing and its troubles with the Chinese government. And lastly, world's largest scooter factory. Uh, it's by Ola. Ola is a competitor to Uber in India. They have it's a ride-hailing company, and Ola itself has raised a humongous amount of venture capital already in their main company, not in the Ola Electric company. And with this, let me, before signing off, let me tell all of you that we at Consultancy Ventures, we have done 12 deals in the last 2.5 years. We arrange venture capital for companies, and we also arrange funds from limited partners for venture capital funds. And we help in documentation like term sheet, shareholders agreement. We help in due diligence. We help in unit economics. We help in frequently asked questions by the investors. We also help in making the pitch deck and valuation of the company and business plan of the company, which is a 25-page project report. Apart from this, we also help and assist startups in planning and pitching to investors. And we also do buy side mergers and acquisitions. And so, any company which wants to reach out to us at Consultancy Ventures or specifically to me, Tushar Kansal, please feel free to reach out on LinkedIn, which is you search my name Tushar Kansal on LinkedIn. Uh, we can connect easily there, or on my website, which is consultancy.com, or you are free to reach out to me by my email ID, which is tk@consultancy.com. So before signing off, I'm just showing you my website, and so that you can connect with me easily over there. Just a moment. This is the website. So on the website, you can see the LinkedIn profile link. You can see the verticals where we operate: financial advisory, investment management, venture capital, mentoring. It has the offerings given separately. Then it has the videos of the talks which we have given across platforms, at the Gary Fowler show on VCTV, at IIT Mumbai, and so all these videos to so that you can educate yourself. And then we have, apart from videos, we have these ecosystem partners where we work together. And this is a small presentation on the company, and these are the recommendations. So these are, the full list is on LinkedIn, but these are recommendations from people who liked our business. Along with their LinkedIn profiles, we have given everything, and this is contact us. So happy to hear from you, and thank you for joining in today. And it was my pleasure to bring out exciting deals from this week. Have a good day, and thanks to Abelbek, and thanks to Hasmek, and thanks to Carol, who are always arranging this whole talk in such a seamless fashion. Have a good day. God bless you. Stay safe. Take care. And till the next week, same time, 12 noon UK time every Tuesday. See you.